Inflation dips, tariffs pause, and Saudi just dropped $30 billion on US AI gear. What does it all mean? CPI is cooling, but we're still riding 50 months above target. Meanwhile, the US and China just hit a 90-day trade truce, while quietly accusing each other of sabotage. And out of nowhere, a $2 trillion Middle East deal with a $30 billion AI twist. This week's moves could shift everything, from markets to power grids. Watch the full video, because these headlines aren't just noise, they're your financial future in motion.
Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, where in the world are you today?
Yeah, Gary, I am up in, thank you for the welcome and glad everyone's online listening, but I am in Northern California a little bit, Monterey area, actually Carmel by the sea, Monterey. Pebble Beach, I think, all of our golfers out there that know the area. So yeah, it's been great weather, staying out here for a couple days, but still, as always, glad that we're able to get on and provide everybody the 5 things to know in investing this week. But yeah, for once, I'm traveling, but I know you're always traveling now. So where are you coming from now?
Yeah, so last week I was in Pittsburgh visiting my favorite cousin Rob and my great uncle Herbie, who's 96. Great to see both of them.
Awesome.
We visited Bubby's old house, my great grandmother, Rob's grandmother. The place where she lived and raised her family. So we had a chance to get a little family history there. And then last Wednesday I caught a flight to South Florida. I'm in Palm Beach Gardens right now, visiting Howard Friedland, who's a member of the DKI Board of Advisors. I've had lunch and drinks with a couple of existing current DKI clients and subscribers and some prospective ones. So we have new subscribers, new business coming in, which is great. Tomorrow I'm having dinner with Tracy Shuchart, Shy Girl on X. And then Wednesday morning, Ninja Trader is hosting me on their show. So, check it out on Wednesday morning on Ninja Trader's YouTube channel. But looking forward to being hosted by them. And then other than that, I spent the weekend, besides working, swimming in the ocean. I love open water swimming and reading at the beach. It's nice here.
There you go. Yeah, nice area to be as well for you. And that's really exciting. Yeah, we've seen great subscriber growth. If you haven't checked out the website, consider, again, premium subscription, especially, over the past couple of weeks, Gary, we've had some nice returns on some DKI portfolio positions. Obviously not going to let the cat out of the bag, so you'll have to subscribe for a premium subscription to see what those positions are that we're really excited about and continuing to be really excited about. But let's get to the work at hand for today. We're calling this the temporary tariff truce issue. Gary gave me a heads up before the show, which is the only reason why I was able to actually properly announce that headline and the title of this week's 5 things. But today we are talking CPI, U.S. and China relations, as I'm sure everyone would expect. Macau, LVS, Las Vegas Sands, we'll circle back to them. Saudi Arabia and their AI play and how aggressive they're going to be there. And then our favorite topic, we'll talk about educating everybody now on the Fed funds rate. I know one of Gary's favorites, and so we'll touch on that for our 5th and final educational thing. But Gary, to kick it off, really excited this week about this issue. We're talking CPI. The CPI fell, where you're saying, hey, Congress is not going to help in any way here. Thing number 1, Gary, CPI falls, but is still above target.
All right, Rob. So for people who are new here, CPI stands for the Consumer Price Index. When people talk about inflation, they're typically referring to the Consumer Price Index. If someone says, hey, inflation was up 2% or 5%, they're referring to the CPI. The April number came in at 2.3%. Now, that's still above the 2% target, which I will argue is 2% too high, but it's also the lowest figure in years. So when you have a decreasing rate of inflation, so inflation is still increasing, but at a slower rate, that's the second derivative for all you calculus fans out there, we call that disinflation. And 2.3% is some pretty good disinflation. The core CPI, that's the number that excludes food and energy, was a still sticky 2.8%. That's not as good. If we go into some of the details, food was up 2.8%, which is higher than it's been recently, but I still think is understated. I think, if your grocery prices are only up 3%, put it in the comments. Let us know. I'd be shocked. Food away from home was up almost 4%. That's a pretty big number. That's leading more people to eat at home. Good for Walmart. That's been helping their food sales. Energy prices were down 3.7%. That continues to be a tailwind. People are enjoying lower gasoline prices. Service prices, which have been sticky for years and a giant problem for Jerome Powell and the Fed, were up 3.6%. That's partly driven by increasing nominal wages, which isn't necessarily a bad thing, but we do still have a bit of a wage price spiral going on where people understandably want to be paid more. And what that does is that increases costs for business. They increase their prices, and then consumers say this is getting expensive. They go to their bosses and say, we need to get paid more. So when people talk about a wage price spiral, that's what they're referring to. There is some of that going on. Shelter, which is the fancy word for housing that they use in these reports, was up 4%. That accounted for more than half of the month's CPI increase. In my opinion, I think it's going to take either lower interest rates or a recession to bring down housing prices, although the housing bears will note that there are certain markets where housing prices have started to decline, and it's been really rough for the people who leveraged up and bought a bunch of homes that they were using for Airbnb. In certain markets, those are not doing well. I think Amy Nixon on X has done a really good job of covering that. She's been more bearish than I've been, but I think she's worth listening to on this topic.
Yeah, definitely. What's Amy's handle, Gary, for everyone listening?
You know what? So that's a great question, and I don't know. I have notifications enabled for her, so I don't know. But yeah, Amy Nixon. She's I think it's something about running in Texas runner, something. You know what? Look it up. But she does really good work on this. The other person who is really bearish on housing but does phenomenal work in the housing sector is Darth Powell, which is one of the great pseudonyms on X. He's a terrific person. He and I disagree on Bitcoin, but I think he's done really good work on housing. So check him out, Darth Powell, with a great username, and he's got a hilarious photo for his image as well.
Love it. That's great. Gary, with this news, right? Obviously everyone looking at what's happening with the interest rates. Are they going to be lowered? Is now, or should the Fed now lower rates? What are your thoughts there?
Yeah, so I don't think, first of all, if I were the Fed, I would not lower at this point. I don't think they have inflation under control. People are understandably excited about the lower 2.3% print, but it's not done yet. They do not yet have inflation under control. The risk is that they lighten up again and end up with higher 10-year rates as the bond market prices in expected increases in future inflation. In my opinion, there's very little the Fed can do right now without spending cuts from Congress. That's something I don't expect to see, despite a lot of the clickbait headlines saying otherwise. I'm a big fan of Doge, but as predicted, they're not going to get $2 trillion of cuts. I think it would be great if they did, but it's clearly not going to happen. Inflation is being caused primarily by congressional overspending, and they're going to flood the economy with more stimulus funds if we have a recession. So be prepared for more inflation. On the Federal Reserve side, if the Fed raises rates, and they're not about to do that, that will, help get inflation under control, but it will be really rough on the economy, which is starting to weaken a bit. But if they lower rates, which President Trump wants and a lot of equity investors want, we're going to see a bear market in bonds. And people might say, well, why does that matter? Who cares? I'm not invested in bonds. Is that an issue? And the reason it is an issue is because Treasury Secretary Bessent has to refinance $7 trillion this year. If they don't get the 10-year down, it's going to be really expensive. We could be looking at $1.5 trillion, $1.6 trillion of interest expense this year. That's a big number. That would put a gigantic hole in the budget. It's something we don't want to see. And so remember, prices and yields move inversely in the bond market. What that means is that if the Fed lowers the Fed funds rate, and the bond market expects higher future inflation, it leads to a bear market in bonds, meaning bond prices come down and yields go up. And for those of you who are waiting for mortgage rates to come down before you go buy a home, and you have my sympathy and good wishes, you also want the 10-year to come down. So, we're all hoping for actually higher bond prices and lower yields, and they're not going to get that if the Fed cuts. So, in my opinion, as much as the issues that we've had in recent years have been partly due to Jerome Powell and the Fed making bad decisions, he's doing the right thing right now to ignore President Trump's request for lower rates and just sitting right where they are. And that's what I would do if I were in that room.
Yep. Yeah, great stuff there, Gary. And we'll be sure to keep everybody in tune with the CPI, the interest rates as those move, and obviously the Fed's decisions. And we got a lot more to talk about with the Fed funds rate later in our educational topic. Moving forward to thing number 2, we're talking about U.S. and China. A couple weeks ago, obviously, we heard the news, some sort of deal, or at least inching closer to a tariff truce deal. Looks like we are seeing some movement. We're starting to get more information about what actually was in those conversations. And also something interesting, Gary, that you'll talk about just in terms of China and their ability to maybe play some games with U.S. power generation. Thing number 2, Gary, we're talking a ceasefire on Chinese tariffs.
So, Rob, you're right. The news on this has changed and changed. So, first President Trump announced gigantic tariffs on China. Then he raised them, and the Chinese got very angry, and they claimed they didn't care about doing business with the United States. They said, we don't care. We'll just, sell to somebody else. But then, remember, they lowered their version of the Fed funds rate, which is, was not an indication of strength on their end. A few weeks ago, U.S. negotiators were saying, we're talking to China, we're close to a deal with them. And the Chinese were out in the press saying, no, we're not talking and we're not close and there's nothing happening. But then last weekend, there was, again, talk from the U.S. side saying we're close or we have a deal with China. And this time, China came out, their negotiators came out and said, yeah, we've been talking and things are headed in a positive direction. So last week, at the beginning of the week, we got the news that the U.S. and China came closer to a trade agreement. Now, it's really important to note that we do not have an agreement with China. What we have is a 90-day reduction in the new extraordinary tariffs. The U.S. was over 140%. At some point, it becomes an embargo. Now, the U.S. for 90 days is lowering their tariffs on Chinese goods to 30%. China, which had raised theirs to really high rates on U.S. goods, they're dropping their tariffs on U.S. imports to 10%. And that's where we got the tariff semi-truce title for this episode. And it's going to give both countries 3 months to relieve some pressure on international trade, with an estimated $600 billion in paused shipments likely to resume. And, again, I want to reiterate, they do not have a deal. They have 90 days of lower tariffs to talk about a deal and see what they can come to. And, it's important to note that the agreement that they came to does feature meaningful action from both sides, but there are still plenty of underlying issues that led to these tariffs in the first place. And that's the thing I want to emphasize. They didn't resolve anything, right? There are reasons the United States is unhappy with our relationship with China and want to change it. And those are valid reasons. And, I understand why the Chinese were not happy seeing 140% tariffs on their exports to the United States. This agreement doesn't resolve those issues. It just brings tariffs down to a reasonable level while both sides agree to talk for 3 months. And so, we need to start domestic manufacturing, but the transition away from cheap Chinese goods could be painful for a while. We'll see what happens here. President Trump is going to have to come back with a deal to protect his reputation. And I know he knows that, as do Chinese negotiators.
Yeah, you're hearing, Gary, especially from the press, right? With, hey, any sort of decoupling from China means that there could be more inflation. Are there any risks with us keeping just our current trade agreements, especially with the press saying, hey, this decoupling is just going to accelerate inflation again even more?
So, Rob, you're bringing up the key issue. And one of the things that's frustrated me on this topic, and we've been talking about it on this show for months now, is almost everybody talking about tariffs and these economic issues only presents their side of the story, right? The pro-tariff people are talking about onshoring manufacturing. The anti-tariff people are talking about inflation and jobs. And so, they're on the inflation side of it. And so it's complicated things because I don't think there are a lot of people other than us talking about both sides of this. Now, the question of whether these tariffs will lead to inflation for the US is a really good and open one. Now, everybody who's, supposedly qualified to talk about it says, hey, tariffs are a tax, you raise prices, we're going to see higher prices here. And that is a completely reasonable and valid way to think about things. However, the other side of that is most countries have big tariffs on other goods. They've got tariffs on US goods coming there. They manage fine. And we've had tariff increases. President Trump announced tariffs in his first term, and people thought that we would have inflation based on that. And we didn't. It didn't happen. So, the experts predicted more inflation then. It didn't happen. And they were it was such not a big deal that the following administration, the Biden White House, kept those tariffs in place and nobody seemed to notice. It didn't bother anybody when it was a different party in the White House. So there's, it's an open question. And I think Anthony Pompliano did a really interesting research piece a few weeks ago where he said, hey, it's reasonable that people think there'll be more inflation, but he went back and actually looked at examples of when tariffs went up. And in general, they did not cause more inflation. I think people underestimate the ability of Americans to start producing again, and that additional production can bring down prices. Now, the other side of all of this is, the people who are saying, well, if we decouple from China, we'll have inflation. And let's just assume for this segment that is the case. I'm not convinced it is, but let's say it is. So they're saying, well, nobody wants higher prices. And it's really easy to say, well, yeah, of course. Mm-hmm. Of course we don't want no one wants more inflation. I hate inflation. We all hate inflation. Right. And so it would be really easy to say, well, great, you guys win this round. You win the argument. However, this is a really important thing to convey because nobody's looking at the whole picture. At least they're not talking about it. Last week, it was reported that China snuck rogue communication devices and solar inverters and batteries. So these are the devices that you use to send power from solar panels produced in China to the grid. And these communication devices are hidden. So normally when the utilities get this equipment, they disable, any communication devices, and the Chinese hid them, so they were very difficult to find. And these communication devices could be used to shut down U.S. power systems, putting the U.S. in a gigantic problem. They could cripple our grid. And so my point in all of this is that while we understand why some Americans are worried about the pain of decoupling from inexpensive Chinese goods, and they're worried about inflation, that's a reasonable fear. We want to point out there are huge costs to doing business with people who engage in this kind of behavior. There are costs and risks to doing business with people who are sneaking in a way to shut down our grid and cause mass panic and chaos. And, what if it's your home or your business or your local hospital that's connected to the grid? What if it's, your fire department that's not getting signals? So, using China's language, we again urge China to apologize for this wrong action and to change course.
Great stuff there, Gary, and interesting developments, especially just as U.S.-China relations move forward. We'll keep everybody in tune with tariff conversations, negotiations, and what those actually mean, and breaking down all the nuance that you hear from the press. You're watching the 5 Things to Know in Investing this week. This is the temporary tariff truce issue. Head over to deepknowledgeinvesting.com. You can sign up for a free subscription. That'll get you added to our email list. You'll receive notifications on all new versions of the 5 Things, as well as we'd love if you consider a premium subscription, access to all of the current recommendations, premium content, paywalled content, and access to DKI webinars, board of advisors, lots of other great perks there. Moving forward on this week's version, next we're talking about Macau, Gary, and talking about the gaming market, one of the largest in the world. We're actually seeing profits rising on bad bets. You're going to break that down for us. I know you've been investing in these types of companies for a long time. Gary, thing number 3, bad bets by players are increasing casino profits in Macau. I think that's a good thing for Las Vegas Sands. I'm sure you'll tell us more.
It is, Rob. And the reason I've been invested in casinos for many, many years is because it is a really good business. You know the expression, the house always wins. The truth is, they have an expected return on all of these games. And you walk into a casino, the odds are in favor of the casino and against you. Given what I do for a living, I don't find losing money to be entertaining. I never want to be the person walking into a casino with cash in my pocket. I want to own the casino, right? I want to be on the other side of this. So, we've all seen the films where the math geniuses and card counters try to beat the casinos in blackjack, right? Everyone has your favorite one, all the different methods they have. But the truth is, and that blackjack, it's really the only table game, and we're going to leave poker aside because in poker, you're typically playing against other players. But blackjack is typically the only casino game where you can push the odds in your favor, but the way you have to do it is by changing your bet size depending on whether the deck is stacked in your direction or in the dealer's direction. And when you start doing that, when you start massively changing your bet sizes from hand to hand, they figure out your counting cards and politely escort you to the door if you're lucky. Now, on other table games, experienced players know the best bets to make. And granted, in the other table games, the odds are still against the player, but they typically know which are the better bets to make. The thing that's really interesting is that in Asia, many players bet based on superstition instead of statistics. And so, you would think you can do the math on all this stuff and say, well, for people playing roulette, this is the house advantage. And for people playing craps, this is the house advantage. And for people playing blackjack who are not counting cards, they know what the house advantage is, and they do the math on that. And they say, we have an expected hold from our table games. Now, hold is the percentage of dollars betted or, whatever currency is betted at the table that the casino expects to keep. And that number is often, kind of in the 3.5% range or so. So typically, if you go into a casino and you're betting, $100, you're expecting the casino to take 3.5 of it. That's, if you don't keep betting, they'll take 3.5% on and on over time. But in recent years, Las Vegas Sands actually increased the expected hold range from table games. And the reason for that is because players were making more unprofitable or bad bets, leaving the casinos with extra profits. So there's a new trend that's put all of this on steroids. It's actually gotten better for the casinos and worse for the players, and the players are making these choices themselves.
Gary, I know in the written version of the 5 things, you talk about side bets, right? And we're seeing that these are tending to be much more profitable for the casinos. So my question is, tell us more about these side bets, and then, how much more profitable and how much of a big difference does this make in terms of looking at a stock like LVS?
So, Rob, this is incredible to me. And this information came from Inside Asian Gaming. In my opinion, nobody covers gaming in Macau and Singapore and the Philippines and what's going on in Thailand and Vietnam better than Inside Asian Gaming. They're the ones I like to follow in that area. One game that's really popular in Asia, especially among very wealthy players, the whales that play there, the super rich, is Baccarat. For those of you who are James Bond fans, right? He's regularly playing that game. When you hear them say "huit à la banque, neuf à la banque," that's the Baccarat game that they're playing. And what a side bet is, it's separate wagers from the game itself. So players might wager on whether the player or the dealer will get a pair on their first 2 cards. They could bet on the margin of victory, which is hilariously called the dragon bonus. So, it's almost, think about side bets like if you're, playing fantasy football and, you're betting on whether the next play is going to be a running play or a passing play, or, you're betting on whether a team will kick a field goal in the third quarter, right? It doesn't affect the outcome. It's just, you're betting on little things. But it is a huge difference maker. What Inside Asian Gaming is saying is that these side bets are making up 5% of the bets, but almost 50% of profits. They are 10 times more profitable than standard betting, which is the thing that's remarkable to me is that players are doing this voluntarily, right? The casino is saying you can make a bad bet by coming into a casino and playing a table game with us where the odds are an advantage, or you can do that and make bets that will get us 10 times more of your money. And they don't have to do this. They're choosing to do this. It is incredible to me. Again, I can't emphasize this enough. And a lot of this is being driven by smart tables, which actually track player bets. They're providing the casinos with more data, enabling them to earn higher profits. I would remind people, when a casino is reporting higher profits, that means they're taking more of your money. Again, the thing I want to emphasize is do not walk into a casino with money in your pocket and go play at the tables, buy the stocks, and own the other side of it. Be the person collecting the money, right? This is what I do for a living. I would much rather own the casino than make the bet. One other thing I want to add, which I think is fascinating. Last week was, it was actually over the weekend, was Las Vegas Sands' 21st anniversary of operating in Macau. Sheldon Adelson, the former chairman and CEO of Las Vegas Sands, was the one to really open up that market and help it grow. He was a phenomenal visionary. And Sands celebrated with something that I thought was really amazing. Every cab driver who brought a player to the hotel, the resort, the casino, got this amazing box lunch. Inside Asian Gaming reported what was in it. This wasn't a sandwich and chips. They got this beautiful, really nice, like 6-course lunch as a way to thank the working people who bring the wealthy players there. It was a really gracious move. I think it's something that they've done annually, but it was nice to see. And when Sands in particular talks about we're part of this community, we've been really good partners to the government in Beijing, to the government in Macau, to our employees, to the community there, and they have been. These are you do enough things like this, and eventually everybody in town has a good opinion of doing business with you. And they're really, it's, from what I've read, very well liked in the area. Gestures like this to cab drivers who happen to be, pulling up to the front door, I think, go a long way. And it was a really kind, gracious thing for them to do.
Yeah, great stuff there. And I know I am a sucker for the side bets. So if anyone's out there in Macau, please do the same and you'll make all of our DKI subscribers and LVS shareholders very, very happy based on those numbers that Gary just laid out for us.
Perfect. Yeah, it's a great idea. We want the stock to go up. So go make the side bets in Macau or Singapore. Exactly.
That's exactly right. All right, Gary, moving to thing number 4, we're talking AI. I love AI and just what's happening in this space and quickly moving, seems like every single week. But we're talking about Saudi Arabia and their investment into the AI space, wanting to become a leader in this space. They bought $30 billion in AI hardware from our friends over at NVDA and AMD. You say that's one way to reduce the trade deficit, no doubt about it. Thing number 4, Gary, NVIDIA and AMD building AI empires. Tell us what Saudi Arabia is doing as well.
Yeah, so President Trump a week ago had a trip through the Middle East, came back with $2 trillion of purchase orders and commitments to invest in the United States. This somehow made a lot of people angry. I read a lot of negative things about it. I'm thinking to myself, why doesn't every president do this? Why doesn't every president travel around the world and act as a representative for our companies, our manufacturers, our national champions and leaders? To me, it's a brilliant use of the office. The truth is, we're all suffering from making too little, from producing too little and consuming too much. It's one of the reasons we have the huge debts we have. It's one of the reasons we have the inflation we have. For President Trump to go get commitments, $2 trillion to invest in the United States and to buy products from our companies, more presidents should be doing this. This is a great use of the office, in my opinion. So part of this was Saudi Arabia. They unveiled partnerships with NVIDIA and AMD to supply chips to the Saudi AI initiative. It's estimated to be $30 billion over the next 5 years. To give you a sense of the magnitude, last year, NVIDIA, their sales to the other countries was $10 billion, right? So they break out the US, Taiwan, and China. Their sales to the rest of the world were $10 billion, and this deal is, $30 billion over 5 years. That's a meaningful amount there. The investment is being made by Saudi Arabia's sovereign wealth fund, and Saudi Arabia, just like we're trying to improve and change our economy, Saudi Arabia is trying to diversify their economy so that they're not solely dependent on oil. I think they realize that the oil may not last forever, although there's more of it than people have indicated in the past. And they're thinking, how do we do this? How do we start to invest for the future and diversify their economy? And they're like, well, let's get into the AI race. And so the partnership with NVIDIA is a plan to provide 18,000 of the high-end Blackwell chips and NVIDIA's cloud GPU services to Saudi Arabia. They're going to create the Middle East's largest computing data centers. AMD got a slice of the pie. They secured a $10 billion deal to provide 500 megawatts of computing capabilities. God, I'm doing this to myself now. Over the next 5 years. And that, puts Saudi Arabia in a great position. As a reminder, a week ago, we were talking about the AI diffusion rule, which President Trump reversed, that had been put in place by the prior White House. That gave U.S. chip makers the green light to increase exports, including to Saudi Arabia and the Middle East. So that's exactly what happened just a week later. It would not surprise me if those two events had been linked.
Gary, you mentioned, securing that $2 trillion worth of investment from President Trump. How much of this, was related to that trip you mentioned to the Middle East? And I know also ending the diffusion rule as well. How much of that is related to these decisions?
So they needed to reverse the diffusion rule to get this deal done. Given that the Saudis do have a relationship with China, there have been concerns, how is this going to work? But part of the deal is a guarantee that these high-end NVIDIA chips won't end up in Chinese hands, or the technology won't end up there. Bringing the Saudis closer to our sphere of influence as opposed to China, I think is good. It works well. Our goals in the Middle East are better served when we have a positive relationship with the Saudis. So I think that was a really good strategic move. We talked last week saying reversing. I don't think the Biden administration's application of the diffusion rule, I understand what they were going for. I don't think it was wrong or dumb or bad. I think the implementation was confusing and didn't necessarily work. And so we were positive when President Trump reversed that without being negative on the prior administration. So that was part of it. As for the rest of it, I don't think that $2 trillion of investment commitments would have come without President Trump going to the Middle East and talking to people and making deals. And I think it's something that he's done that, he should get a round of applause for. He should get credit for it. And I found it a little bit disturbing that I understand why some Americans don't like him, and that's fine. You don't have to. But when he's securing wins for our companies, people who are going to get jobs as a result of these investments, I'd like to see people cheering for the United States. And so, we're not making a partisan call here. We're saying, as, U.S. citizens, we're happy to see more investment here, more building here, more domestic manufacturing capacity, and more jobs for Americans. So we're very positive on this deal.
Yeah. And I mean, I think it speaks to what you said earlier, Gary. It's like, why isn't every president doing this, right? And I think it's been refreshing just seeing, that show of strength. And look at what's happening, right? You've got these countries, organizations that are just lining up because, I think we have been getting taken advantage of for far too long. And you're starting to see some of that reverse course. And you're exactly right. Democrat, Republican, my opinion should be what every president is doing, is getting out, doing his job, shaking hands, having conversations, negotiating new and better deals for the American people. So great stuff there. Any thoughts on that, Gary?
Yeah, one thing to add on that, just a reminder, he had I want to say it was $1 trillion deal for Boeing that he got the week before. You know,
Yeah, hard to
that's
argue with that.
yeah, these are, remember, we have a gigantic trade deficit that's leading to problems here. And we have a manufacturing sector that's been hollowed out, making it hard for people to get jobs. That's been going on for 50 years.
Right.
And, with China, it's been going on for a good 30 years, maybe a little bit more. Seeing efforts to reverse that and trillions of dollars of purchase orders and investment being brought into the United States, that's a win for all of us. So, we're not we're not cheering for Team Red or Team Blue. We're cheering for Team Red, White, and Blue here.
That's right. Great way to put it, Gary. Again, you're watching this week's version of the 5 Things to Know in Investing, the temporary tariff truce. Issue.
Got it.
Got me on that one. Got me on that
I knew we'd have it.
Yeah, that is tough. I was staring right at it too, so that was probably the problem. But anyways, head over to our website, deepknowledgeinvesting.com. We'd love if you use the Ask Gary feature too. Send in questions that you might have just about anything investing, markets. Your question may end up on the show as well. And again, check out our premium subscription, $100 a month. That'll get you access to all of the content on the website, no paywall, access to Gary's buy, sell recommendations, the whole 9 yards there. And like I said, yeah, it's been a fun last couple of months for DKI subscribers. Gary, shifting gears, wrapping up this week's version of the 5 Things, our educational topic. Today, we're talking about the federal funds rate. Fed funds rate, as we generally refer to it. We've talked about it a ton ad nauseum over the course of this show. But today we're going to talk about how to understand the Fed funds rate. Gary, why don't you give us a high-level overview real quick, and then I've got a couple of follow-up questions for you.
All right. So the federal funds market represents a portion of the Fed's reserves. And what that is where banks lend to the Fed or to other banks, typically overnight. The Fed can also loan funds to banks overnight. And banks rely on the system to meet liquidity requirements in a short amount of time. So remember that because we have a system where the banks can actually, it's called a fractional reserve system, and the banks can lend out more money than they have. They can be on like 10-to-1 leverage. They have to keep a certain amount of reserves. And so if they write, a certain number of loans and they may not have enough reserves, or they may have too much in reserves, they can go into this market overnight and borrow on a short-term basis. And so the interest rate for these overnight loans is called the federal funds rate, and it's typically, understandably, viewed as an essential benchmark for all other interest rates in the economy.
Gary, in terms of the Fed funds rate, because I think you see it often correlated, right, with mortgage rates and everything like that. Does the Federal Reserve set all of the interest rates, or how do we have to think about that?
The Fed only sets the overnight rate. It's called the Fed funds rate. The bond market, which is, you'd refer to that as a free market, sets the interest rates for everything else, whether it's 1 week, 5 years, 10 years, 20 years, 30 years, whatever it is. But typically, in a normal situation, those rates get set based off the Fed funds overnight rate.
Gotcha. Gary, we talk about yield curves a lot as well. So I know there's a couple different types of yield curves. The first I want to start with is tell us what a normal yield curve is.
Okay. So with a normal yield curve, interest rates rise as duration does. And that sounds complicated. It's actually really simple. Just think for a minute about somebody lending money for 1 year and how much, they'd say, okay, well, we have an interest rate on that. But now imagine that you're an institution taking the additional risk of lending for 30 years. You're trying to project out 30 years. Will this business or this person still be in existence? What will happen to inflation over that time? What will happen to the value of the money that you receive? What will happen to our economy? What will happen to the dollar? You don't know for 30 years, almost a third of a century, if the people you're lending to will be in business or not. So if you're lending for longer, you would typically, under normal circumstances, ask for a higher interest rate. So right now, the middle of the range on the Fed funds rate is set at, right around 4.3%. And so with a normal yield curve, what you would see is the 1 year being a tiny bit higher than that. Maybe I'm making this up. This isn't where we are right now. But, you might see like 4.4 4.4, 4.5%. And if you go out to 5 years, you might see another 10 or 50 basis points there. And if we went out to the 10-year, you would get a higher interest rate for that, and so on. So as lenders lend for a longer period of time, they ask for a higher interest rate to compensate them for the additional risk. And that would be called a normal yield curve, where the interest rate rises as the length of the loan, called duration, does.
And Gary, what about a steep yield curve? So I know that's something that's a little bit of a variance off of a normal yield curve.
Yeah. So Rob, when the yield curve is said to be steep, is when the interest rates rise a lot as duration increases. So, we were just talking about, where as you go through the different points in the yield curve, the market might ask for maybe another 10 basis points or a tenth of a percentage point of interest. That would be a, normal or shallow yield curve. In a steep yield curve, those increases might be 50 basis points or 100 basis points, where people are really uncertain about the future. And they're saying, yeah, I'm okay lending to you for a year, but if you want longer than that, we're going to charge you more. You want 10 years, we're going to charge you a lot more, So that is a sign that people are, seeing some additional risk there. And when interest rates rise disproportionately higher as duration increases, we would call that a steep yield curve.
Gary, and then finally, in terms of just types of yield curves, tell us what an inverted yield curve is.
So the inverted one is really interesting. When the yield curve is inverted, you have the opposite of what we just described. You would have a situation where, as you go to the longer durations, the market asks for a lower interest rate. And so, somebody might say, well, wait, why would you do that? Why would you offer somebody a lower interest rate for a 10 or 20-year loan than you would for, say, a 2-year loan? And the reason that happens is because when the yield curve is inverted, and typically people will look at like the 2 to 10-year pairing, if the 2-year yield minus the 10-year yield is negative, they'll say, hey, we've got an inverted yield curve. And that will often signal a recession. So the reason for that is because people are projecting a weaker future economy, and they're saying, wait a minute, we're going to hit a recession. When that happens, the Fed is going to lower the Fed funds rate and bring down the whole yield curve. It doesn't always work that way, but that's typically how it works. And so, they're saying, wait a minute, if the Fed is going to lower, in the next 6 months or something like that, then, we don't need to ask for as high an interest rate in the future. But the key thing on that is it's typically a danger sign, because often when the yield curve uninverts, we end up in a recession. Now, that's something that just happened recently. So, we'll see if we end up with a recession right now. It's worth noting that first quarter GDP was negative, but that was on an anomaly. I don't think, it was necessarily the economy there, although that was an issue. But the first quarter negative GDP growth was actually related to inventory stocking ahead of tariffs going into place.
Very interesting. Thanks for breaking down all those types of curves, Gary. Let's talk now about low interest rates, high interest rates. I want to start on the low side because I think people enjoy talking about low interest rates more. But what are the advantages or disadvantages, Gary, of lower interest rates?
So when interest rates are lower, it encourages building and investing. So think about it, Ralph. Let's say you and I wanted to build a plant to produce something, and we could get a loan for, let's use a ridiculously low number, say 1 or 2%. Now, that's obviously an insanely low number. And we say, oh my goodness, like the market is willing to give us money for free or almost for free. And it won't cost us a lot to borrow money and try to build a new plant. And so with an entire economy thinking like that, it will encourage building and investing. The downside of it is it leads to an increase in asset prices, it leads to inflation, and it also leads to uneconomic, wasteful expansion, right? If everybody in the economy says, hey, money's free, we don't have to worry about a good return, let's just build stuff. If it works, we make money. If it doesn't work, we lose somebody else's money. You can end up with a lot of uneconomic and wasteful spending and growth. And by the way, that's the problem that China has had in their property market, right? They made it so that the funding was effectively, zero or negative, and companies like Evergrande went out and they built more than there was demand for, and people who paid for apartments didn't actually get them. That kind of wasteful expansion leads to giant problems. In fact, the best examples for this are in China, where they have entire ghost cities. They built entire cities and nobody's living there. These places are just rotting.
Yeah, I know we talked about that. I think it was summer of last year, about these ghost cities, right? Just the Chinese real estate market. On the flip side, Gary, so let's not talk about high interest rates. Advantages, disadvantages of high interest rates. Curious on the advantages.
Yeah. So the disadvantage of higher rates is they tend to slow the economy. Just like we're saying, lower rates encourage people to spend and invest. Higher rates, they make it harder. And if you're going to build something new, you think, wait a minute, this is going to be expensive. How much capital do we want to put at risk here? How big, how much financing can we take on? It becomes more expensive and harder to do. But the advantage is higher rates tend to, when they slow the economy, they bring inflation under control, and stable prices are crucial to economic growth. Where you have a lot of inflation, you tend not to have a lot of economic growth. The uncertainty prevents people from investing for the future. When people feel like their currency is stable and inflation is under control, and they have a good view on what's going to happen in the subsequent years, they say, hey, if I know what's going to happen, if we have a stable currency, that encourages people to invest. Higher rates also encourage a greater deal of caution and certainty when building new capacity. And so it doesn't eliminate it, but it reduces the probability of these, negative return, wasteful projects getting built. You clean out the kind of the garbage. Yeah. And there's an expression in the economy right now, they're talking about zombie companies. These are companies that under normal interest rates would just go out of business, but because they have financing at insanely low rates, in some cases around 0%, they don't run out of money quickly enough, and they have no value. They should be shut down. The assets should be sold off. The effort and resources going to keeping these businesses going and keeping them alive would be better spent on other kinds of things. But because these businesses don't die, and you don't have what's called the creative destruction of capitalism, these worthless businesses keep absorbing people's time and energy and resources. Higher interest rates put a stop to that, and they make that kind of waste much less likely.
Gary, finally, to wrap this up, this is great. We've been covering a ton of different stuff here on the Fed funds rate, and I think as much as we talk about it, good for everybody. Finally, last question I had. You talk about, okay, these interest rates. In your opinion, how should these interest rates get set, right? I know you are and the Fed. I won't ruin the punchline, but yeah, how should these interest rates get set, Gary?
Well, Rob, that is the punchline. So I want everybody, people will often say, well, we need the Federal Reserve. Why? Well, they set interest rates, they provide financing. Okay. No, they make it possible for Congress to overspend. They make it possible for us to monetize our wasteful, enormous, multi-trillion-dollar deficits by, just writing paper for this. It's a disaster, but I want everybody to go through a thought experiment with me. Right now, if we have, 1 week debt, right? 1 week paper, the market sets the rate for that. If it's 1 year, market sets it. 2 years, 5 years, 10, 20, 30 years. Everything from 1 week to 30 years is set by the market. Why would it be so awful to have the market set the overnight rate? That's all it is. People talk about the Fed funds rate like it's this magical thing that can only be set by the Fed. This is 100% not true. It is simply the overnight rate for lending. It can and should be set by the market. And personally, I would much rather see the collective wisdom of the crowd, the collective wisdom of everybody participating in the market, replacing the decisions of a few unelected bureaucrats, most of whom have never run a business. So here's your tagline, Rob, everybody all together now end the Fed.
Great stuff, Gary. Great stuff. And that's going to conclude this week's version of the 5 things the temporary tariff truce issue. Just need to take breaths in between each of those T's. Even the is in there. Wow, Gary.
Yeah,
But
I made it hard.
Yeah, great episode. We'll be back same time, same place next week, keeping you in touch with everything that you need to know in investing for the week. Again, head to our website, deepknowledgeinvesting.com. Use the Ask Gary features. Send us an email via ir@deepknowledgeinvesting.com. Check out our content. Again, some of that will be gated for our premium subscribers. We'd love if you consider transitioning from a free to a paid premium subscriber. And if not, no worries. I know Gary will tell you that as well. Thank you for watching. We'd love if you could like, subscribe, or dislike, and let us know why. That's super helpful too. Gary, turning it over to you for closing thoughts.
Thanks, Rob. Well, first of all, thanks for doing this. I always enjoy our weekly chats like this, even when you're traveling, when I'm traveling. Actually, DK intern Cash and Crow is heading to Europe tomorrow. I think he's headed to Spain, which is fantastic. And he's going to be traveling in Europe for a few weeks. So we may have multiple people writing the On Adventure series, but everyone's traveling and we still pull it all together for this. Really appreciate you and the team at Flying V. Another great week from our intern, Cash and Crow from the University of Tennessee. You know, he's very young. He just finished his freshman year, but the quality of work that he puts out is incredible, learns quickly, just turned himself into a producer much faster than I had even hoped for, which is terrific. And for everybody else watching this, thank you so much for watching. We really appreciate your time. We know it's valuable, and thank you for spending it with us. If you want to like and subscribe, that would be great. If not, hey, we're not the boss, so you do whatever you want. But either way, we will see you next week right here. Looking forward to finding out what's going to happen this week. Thanks so much.
Thanks, everybody.